People talk about interest rates like they determine whether buying real estate is a good idea or a bad idea. That's not how real estate works. Some of the worst decisions people ever made were in low rate environments. And some of the best opportunities happened when rates were much higher than they are today. But most people, they don't ever hear that part of the conversation. Because the way rates are discussed today publicly is oversimplified, and I mean way oversimplified. Everything becomes rates are too high, nobody should buy, or rates are dropping, now's the time to buy. Real estate doesn't actually work that cleanly. And honestly, I think rates have become a psychological trigger and barrier more than anything else. The second rates move, consumer emotion moves with them. Confidence changes, headlines change, people start freezing, waiting, speculating, trying to predict what happens next. And in a lot of cases, people are making decisions based more on fear and uncertainty than actually having a strategy in place. And that's what makes this market really interesting right now. Because consumers became conditioned to cheap money for a long time, a very long time. Historically, low rates lasted long enough that people started treating them like they were the norm. But historically speaking, what we saw over the last several years, that was not normal at all. And when rates were extremely low, people stopped paying attention to a lot of things they probably should have been paying attention to. Like risk, margins. Can I actually negotiate? What about the price? People stopped caring about the price entirely because they wanted to make sure they had that perfect rate. That environment created a lot of emotional buying behavior. And honestly, low rates hid a lot of bad decisions. People could overpay, stretch themselves, ignore future expenses, all looking smart while appreciation was moving, but it doesn't last. That's important to understand because low rates alone do not create smart real estate decisions. Strong positioning creates smart decisions. And right now, I think people are focusing on the wrong variable. Most consumers are staring directly at interest rates while barely paying attention to the actual structure of the deal. They're asking, should I wait for rates? Instead of asking, does this purchase actually make sense? That's a completely different conversation. Because you know what? Rates are only one piece of the equation. Price matters, payment, negotiation, inventory, holding periods matter, and future flexibility matters. One thing a lot of people overlook. And competition matters more than people realize too. One thing a lot of buyers miss is that low rate environments usually create significantly more competition. More competition, it can drive prices up. It can get rid of that negotiation leverage. You can wind up in a bidding war. And it a lot of times forces buyers into emotional decisions. Meanwhile, in a high rate environment, buyers sometimes gain leverage they didn't have. Sellers can become more flexible. Inventory can sit longer. Negotiation opportunities increase. And you start seeing a lot more concessions from sellers. That doesn't automatically mean higher rates are better, but it does mean the conversation is more nuanced than it sounds usually. And honestly, I think that is where a lot of buyers accidentally trap themselves mentally. They become obsessed with timing rates perfectly. It's got to be the right rate. The problem is nobody consistently times rates perfectly, and nobody consistently times the market perfectly either. What smart buyers usually focus on instead is positioning themselves intelligently within the environment that actually exists today. Can the payment work for me comfortably? Does this property make sense long term? Is there room for me to refinance later if the rates improve? Does the deal make sense even if the market softens temporarily? Those are strategic questions. And strategic questions create better long-term decisions than emotional reactions to headlines. Same thing applies to sellers. A lot of sellers think rates alone determine whether their home will sell. But buyers are still buying every single day. The issue is that buyers became much more selective. That means pricing strategy matters more, presentation matters more, condition matters more, and perceived value matters more. Because today's buyer is analyzing much more carefully than buyers were during the aggressive growth cycle. And honestly, that's probably a healthier market for the long term. The market today feels less emotional than it did a few years ago. That doesn't mean that all opportunity has disappeared. It just means consumers are being forced to think more carefully again. And I think that's one of the biggest differences between people who consistently do well in real estate and people who struggle with it. The strongest buyers and sellers usually are not the people reacting emotionally every single time the market changes. They're the people who understand how to adapt. Because every market rewards something different. Some markets reward speed, some patience, some reward aggressive negotiation, and some long-term thinking. But the people who consistently perform well are usually the people who understand positioning better than the people around them. And right now, positioning matters far more than obsessing over one number on a mortgage screen. Because interest rates are not the entire market. They're just one little variable inside of it. I'm Brandon Williams. I've been in real estate since 2007. I've worked across residential, investment, land, and development. This is Scale. It's where we break down real estate, business, strategy, and market psychology through a more analytical lens so people can make stronger decisions in a constantly changing environment. Join us each week, and if you like what you see, subscribe and follow along. And always, comment, let me know your thoughts.